evening and welcome to Personal Finance. I'm Dumisho Greater. Investing in property could be rewarding with high returns, provided you get it right. John Loos, he's a household and property sector strategist at FNB Home Loans and certified financial planner, Sydney Sekese. Join me for a look at whether you should be looking at investing in a house in the township versus a lifestyle apartment to lay a solid foundation for returns. Gentlemen, thank you so much for joining me. Sydney, let me start with you. Yes. What is the difference between the two? Township investment versus a lifestyle apartment? Is this just with regards to affluent areas where you would find a lifestyle apartment?
Yeah, thanks for that, Jimmy. I think townships were established a long time ago during the apartheid era, but after 1994 it's been open to everyone, and there are houses that are established around cities like Pretoria, Sandton, or even across the country. And when we look at lifestyle apartments, they're more closely to new surroundings, like where there are malls and new establishments. And you find that apartments are more, they appear to be more affluent looking than township, but generally, you know, they're both investments, and they both have risks and return spectrum.
Yeah. John, let's pick up on that. The risks and returns, they're both investments, but as an investor, what are the things that I should keep in mind before I jump into any one of those?
I think it's important that when I interpret the word invest, I talk about people who are buying to buy an income stream. In other words, buy to let. You know, buying your own house to live in is not quite a pure investment. So when you're buying to invest, in other words, you're buying into an income stream, very important is to look, for one, at the income relative to the price. In other words, the yield on that property. And what you tend to find is that as you go down the price ladder to the lower end, the yields get better. They get higher. That simplistically could mean that's more attractive, but it's not that simple. There's the risk involved as well. Now, it's not just as simple as when you go down the income or down the price ladder, you get to a higher risk investment. It's somewhat different. You find, if one looks at TPN's data on tenants in good standing, you find, yes, below the 3,000 per month rental, a higher percentage that are not in good standing, so that's a bit more risky. Then you go up into the middle, sort of the main segment, that's very good, 86% of tenants in good standing nowadays, which is quite a good number. And then on the very high end, again, you actually seem to get some troublesome tenants again. So the very high and the very low end seem to be the trouble areas. So you've got to educate yourself with that. What, you know, your tenant risk is, you know, in areas, in income bands. You've got to vet your tenants well, which you can do with the help of people like TPN now. And then, of course, very important, look at that yield. And that's not just, you know, there's some people that might perceive that this high-end investment, because it looks good and it looks beautiful and it's well kept and everything like that, must be a good investment. Not necessarily the case. History shows that not at all times do the high end get high capital growth or for high base. Sometimes it's the low end, and they don't generally get the best yields either. Those are the considerations you need to think about.
Sydney, the banks will obviously have questions about this. So if I am now looking to invest and wanting to buy any one of these properties, will the banks be more favorable to one than the other? Like John said, there are perceptions about this. So will a township investment be viewed as less favorably than the high end?
Sure. I just need to add on what John has alluded. You also need to be sensitive in terms of the profile of your tenants, because in townships, if you get a proper profile of tenants, you find that in a township area, they're more flexible in terms of their lifestyle. I think most of the guys enjoy going to funerals. And if you go to funeral in a township, it's more flexible than in an apartment. So you need to understand the profile of your tenants. And coming back to your question, it all boils down to valuation of the property and also the location. And we find that in townships, the greatest challenge is the informal settlements, and there's a higher risk there in terms of valuating the particular property that you might want to acquire. So as a result, it depends really on how your property is being valued. Yeah.
Where are people seeing growth? Are we seeing people flocking to township areas? Because as Sydney mentioned earlier, it is surrounded by malls. It is upcoming areas. We're seeing a lot of investment into these malls. So are we seeing more investors going there? Is that the trend?
I struggle to get a grip on that because, you know, when you look at analyze deeds data of who's purchasing where, I mean, really you can't see who's an investor, who's buying to let, who's buying to live. Tough to say. I mean, all I can really say is that it seems as though the former township areas have they have a more constrained supply relative to their demand in recent times. The price growth in the former townships, according to our measurements, has been slightly better in recent years. They are still the cheapest, but the price growth has been slightly better. And as I said, generally as we go to the lower end, and on average the townships are the lower end of priced end, the yields get better. But where, you know, where the new investment is taking place, the buy to let trends, that's very difficult to pick up.
Sydney, have you picked up any particular trends as being a certified financial planner? Are you seeing certain people coming to you for certain types of investments? Yeah,
amazingly, these lifestyle apartments, they are turning into townships themselves because they actually have recreational facilities. You've got hospitals around those or even in that unit. So those apartments are actually going back to the township mentality where you know, there's a lot of communal interaction with your neighbors. So I think that there is a trend of people wanting to be in lifestyle apartments. And there's also an aspiration for those guys who've been living in townships to actually consider the lifestyle apartment. Having said that, it all depends on the lifestyle that you know your tenants or you yourself are accustomed to, and you want to prolong or to continue living. You know.
John, the attractiveness of these investments, and you mentioned yields. What type of returns am I most likely to make? You know, we'll start off with the township, and then you can talk about their lifestyle apartments.
Sure. No, very, very tough to get your generalization. I mean, we've tried on residential side. There's not the well-developed data on yields that you have in commercial yet, but we've estimated a sort of a national average yield that's gross yield. We haven't got to the net yet, but of not far from 9%. Okay, now you net it for operating costs, that would be nearer to 7 to 7.5%. But and the higher end, you know, when you get to the sort of very high net worth end, it could go down, you know, closer to 5 or 6%. When you get to the former township side, the lowest priced end of the market, you may get into sort of low double-digit figures, you know, somewhere above, you know, 10, 11% or so. That gives you maybe a rough idea. The yields have improved since they were probably at their worst or most unattractive lowest around about 2007 at the end of the price boom, and they have increased somewhat or become a little bit more attractive since then, but still probably not wonderfully attractive compared to pre-boom years a decade and a half ago or so.
How much money would I need if I wanted to start investing now in either one of these investment opportunities? What's a good amount to start off with? Tricky question.
Very tricky. Yeah, I think again, you need to have your own financial planning in place and to determine your affordability in terms of that investment. So if you consider property to be a long-term investment and you've got extra cash that you may want to use for that property, you have to do your homework and also consult with relevant valuators and also assess the affordability. I think that's the key takeout in terms of how much you can afford. It must not distort or be out of line with your financial planning.
Sydney, just on with regards to that, either you or John can jump in. Which vehicles do you think might be suitable to give you the types of returns that you might see with these types of investments?
Yeah, I don't know if John may want to.
Probably defer it to you.
Yeah, I think if you're an astute investor, you may want to consider listed property. You don't have the hassles of having to chase your tenants and having to worry about the valuation of a property. I think it's a prudent way of acquiring those returns. And it has, over the past few years, it has outperformed inflation considerably, I think.
I think if I can add in there, yeah, I think you've got to think about your own personality when you invest. Now, listed property traditionally has been commercial property. It's not, hasn't been a way of getting into residential in this country, but it sounds like that's coming, that may be coming. And the thing with listed property is it's more diversified. It's a whole portfolio of properties that you invest into. So whereas there's serious concentration risk when you as a small landlord have one investment house, you've put all your eggs in that basket, and if your tenant goes bad, you have a major problem. It's a costly problem. So it's a concentration risk that you have when you're directly investing. Listed property can resolve that. You've got this management team that does it for you. It's less hassle and all those nice things. And I think that's very important. It's not everybody's cup of tea to manage tenants. It's not my cup of tea. Personally, I don't like it. Other people enjoy it. You've got to know your stuff when you manage tenants and know your legal rights and obligations. So one must seriously consider that, not just the pure returns that you can get, also your personality. There's too many people, and I saw it round about the boom years, they piled into rental, buy-to-let property, thinking this is a passive investment, I can sit back, the money's just going to roll in. Not so. It's an active investment. You've got to manage your tenant. When those things go wrong, it ends up being a loss-making exercise. If you don't like that prospect, then the listed funds are possibly the way to go.
Let's recap some of the key takeaways from this discussion. Sydney, your key takeaway.
Investing in property should form part of a whole financial plan, and you should have a reason for investing in property, and also the term of investing, I think, is very key.
John?
There's no right or wrong as regards to investing in the so-called low end or the so-called townships or the higher end, say luxury. You've got to consider it on a risk versus return basis. The returns can often be better on the lower end, but sometimes, not always, it comes with a higher risk as well, and you need to ponder those you need to balance those.
There you have it, and that's it for Personal Finance this evening. Thank you so much to John Loos, Household and Property Sector Strategist at FNB Home Loans, and Certified Financial Planner, Sydney Sekese. Remember that we'd love to hear from you, so you can tweet us or send us any comments to @CNBC Africa using the hashtag Finance410. From me and the rest of the team, have a great evening.